Good morning, everyone, and welcome to our second quarter review of the markets. And I have with me today Stuart Paxton, and many of you have met Stuart Paxton before. He's our external, you might say, expert on long-term care insurance, Medicare, Part B, and Stuart has done a very good job over a number of years, I feel like, helping you with and us understand some of these issues coming up. But I felt it was a good time to help you through some of these experiences we've had, some perspective perhaps in the last 18 months, especially of the markets, and a lot of questions and concerns, I know, because we get asked each day, and seeing you, the questions with regard to budget deficit, spending, major borrowing going on. Of course, inflation is on many of your minds. A lot of you have lived through that before in the past years and seen and experienced some taste of that. And also the markets. Markets have had some very good run-ups, and also some scares just 18 months ago, roughly. So we've created some PowerPoints for you, and we want to do like we did last time. We were together on March 27th for one of these, and I felt it was very productive with your questions, and so we want to open this up to questions as well, and make this kind of like a forum. And there's so far, I think, 100, and I think I was delighted to see 130 some folks, many of you married, so we could count that even as high as 200 folks attending today. And I find that delightful. So anyway, we'll go ahead and get started. And you have a brief summary here with long-term care. We're going to cover that in Medicare updates and market perspectives, the first two bullets later in the morning. And then I want to go through the market perspectives, and Stuart wants to go right after me with answering your questions and giving you some perspective on the first part up there. Inflation. We can go to the next slide now. These are the drivers of inflation. Many believe, including myself, expansionary monetary policy. We could define that as the printing press is cranking up lots of currency, the way that the Federal Reserve loans money to the 12 Federal Reserve banking systems around the United States and exchanges bonds for cash and so on to encourage monetary policy and almost force it through the system. You're all aware of the checks that have been coming through in the past 18 months, two times at least over, and also for businesses that were slammed. So that's a form of monetary policy. And then we have consumer demand and durable goods. And so consumer demand is, you need to have a strong consumer demand to spike inflation, and durable goods is dependent upon how many durable goods on shop floors, how many are on the shelves, how much do we have in supply, and what is the supply and demand of those durable goods, such as automobile axles, steel, wood. You know, wood has had significant run-ups and more than doubled, in fact. Lumber, it's come down a little bit recently. Then the housing market. We've all seen some huge run-ups throughout the United States. There's not I can't think of any hearing at any time in the last couple of years anywhere spared, any geographic location spared from run up in housing in the United States right now. So certainly in this area. And then interest rates is a factor too. So interest rates are something that has shown in the past as one of the key indicators of if you're going to have high inflation. It's not absolutely necessary, but it is part of the expansionary money supply. So it fits in there more often than not, cheap money. And so we have very low interest rates, as you know, right now. We've had those for about a decade now, low interest rates after the big drop in 2007 and 8, and the velocity of money. So how often is money turned over every period, such as a calendar year, 12 months, quarter? So if a dollar changes hands 1.4 times, that's not in itself just enough. You would need a faster velocity of money changing hands than typically 1.4 times in a normally healthy running economy. So the velocity of money right now is not really high. There's a lot of money sitting in the sidelines, actually. We can see that through what's called M1, M2, M3, M4 money supply. M1 is the cash that's in your wallet, and then you go up through M2, which is the cash that's in your ready cash reserves, like savings accounts, checking accounts, and on up to M3, which is stock market, money in the markets, bonds, and so on. So liquid money up through M3. But what we have right now is an opportunity for money to move, and that would really spike inflation much higher potentially, and that has some people very concerned. Many of the ingredients right now are in place for a much higher inflation, and in fact we've seen some numbers come out in the past 30 days that show that inflation has in fact risen a lot. So we could go into the next slide now, and here's some definitions I wanted to have up for everybody. Also, I want to have you know that if anyone wants these PowerPoint slides, I'm more than happy to have these emailed over to you. So if you email me or anyone here in the office, just put Thor in front of McIlrathEck.com, Thor@McIlrathEck.com. I know most of you know my email. Then I'll be happy today to send this over to you. CPI, this is a consumer price index. It's a very commonly known way of gauging inflation. There's many different forms of inflation, as some of you have heard me say before. It's not something that is going to be perfect for any one of us, because we all consume a different type of goods. So somebody putting kids through college themselves or so on, they're going to have a different inflation rate than someone who's retired and has their health care paid for, maybe by Boeing or where they used to work, and they're now retired, and they're not in that same inflation cycle as somebody that may be in their 30s and 40s or 50s. So core inflation is another gauge we can use to look at inflation, and that strips out some of the things that are more volatile. Actually, the core inflation is basically the CPI with the most volatile items broken out, is I think a faster way to say that. So we could, it doesn't include food and energy prices, which can be more volatile in different times of even the year. So there's a couple different ways of looking at it that I think are appropriate. We can go on the next slide now. And here's an example for you that we found to show you from the Bureau of Labor Statistics, US Treasury, the latest in inflation. You can see that when you look at total consumer price index and core measured by the blue and the red lines, when you look at the end of this graph, you can see April 2021, the spike right there, and it continued on through May. We're very confident of, and the trend line, it's moved above the trend line of just the last year and a half. So almost year and a half. So we can see it for ourselves right here. You want to do that? Yeah. Okay. So this is another slide that I really struggled with in deciding whether or not to go over this with you, but I decided to go ahead and show you this slide. This is income earned on $100,000 in a savings account over the last 20 years. Or is this 15? I think this is 15 years we showed on this thing. So what we have, no, this would be 25 years roughly. So what we have here is different lines, and these blue lines you see on these bars going from 94 to 21. You can see in the blue lines that that is the income that a savings account generated for somebody with $100,000 in a savings account in each of these years. But what you can see on the far right in 2021, this ends in June, that a savings account so far this year, the average in America has only generated $80 of income. And you can see the paltry returns starting in 09 on through. So this was the part I was really hesitant on, but I do think it's important as a reference point, you can see that to year to date, to keep pace with the government numbers on inflation, which are probably lower than reality for a lot of us, is $909 year to date as of just a week and a half ago. So $80 versus $909 to meet the is very unlikely. It's not happening. So this is a reason why a lot of investors, I have a feeling, are increasing their risk, and they're buying more risk assets in such as stocks and real estate, because they're not getting the returns anywhere else. Then we can see income needed to beat education inflation is 1,045. That's just year to date. So these are the problems shown right here in a bar chart when you hear people complain about what they're earning in a savings account. Next slide. And this is a picture of a house, and I'm thinking there's something wrong with this house. I'm thinking it needs a new paint job on it pretty badly. I'm ashamed to say that's my house. So this is a house that we raised our sons in, my wife and I, for roughly 15 years, and it's been rented. And I wanted to show this because sometimes when I get really suspicious of what I read or hear in the news, I go and go to the original source and look at different rates of inflation and so on. And sometimes I'll just turn to the obvious client or myself that I can reference from. So I went into the Consumer Price Index based on the Bureau of Labor Statistics website that I've shared with many of you over the years. And I punched in what I paid for it, my wife and I, in 2001, $238,000. On December 3rd, we moved in that house. And we moved out of it roughly 4 years ago. And today's value, just based on the Consumer Price Index, would be $362. Now, residential real estate records exist going back hundreds of years. And generally, residential real estate on average is about 1.5% above the long-term CPI trend. So it would be higher than this because it is residential real estate, and clearly some people pay for maintenance and so on. And I was shocked to see that this place needs some new paint, but other than that, I think it's probably in really good shape. But you can see the value is 638, and I realize Zillow can be controversial in a lot of opinions, so they put a range in here, especially with the volatility today that we're having in residential real estate, 581,000 to 690. That's a wide swing. But the CPI calculator says it would be 362, and then maybe add 1.5% over a range of time of roughly 20 years, and there you would have your number less than 400,000. So that tells you something right there, I think, that some things look to be out of whack, and one of them may or may not be in the CPI index, depending on how you want to gauge that. But gives you a reference point. Also, for some of you, a few of you own rental real estate, and this might be a reminder that it's important to check on your rents with inflation. And when we rented this to the family, when we moved out, it was $1,600 a month, and I think it's still $1,600 a month. But Zillow is suggesting $2,877. So maybe I'll ask for a vote if we should raise the rent on. No, well, let's go ahead and go on to the next slide. Federal finances. Let's get into this real briefly. I know this can be depressing. And federal deficit trends over time. This is an interesting slide, so I wanted you to see this morning. You can see from 2000 to 2020, and some shaded areas in there that show you the recessions in the same period. So not major market drops like you saw in 2000, 2001, and 2002, but recessions. And so you can see that we've had 2020 on the far right as significant and substantial deficit spending. And I'll show you another slide here in a minute that'll help you to see that a little more clearly. You can see that where we have some deficits on the look to the left, and you can see the borrowing open dotted line here. We're borrowing 44% to fund all of our federal spending right now. Now, this is not government spending, this is the federal spending. And we have some forecasts on into the future, which have never happened. So I don't want to waste your time really looking at that. But this is off of the CBO numbers. And you can see the federal budget surplus deficits on the upper right column from 1990 to 2000. So we got a nice 20-year, 30-year span there. And we can see that when I say 20 years, I can't believe how fast time's flying. It's hard to imagine that was just 30 years. That was 30 years ago. So we can see the lines for ourselves. And then federal net debt on the bottom right to 2020, you can see that we're up there almost to post-World War II numbers. And the forecast is showing some kind of rosy forecast of the subsequent almost decade dipping and then coming back up. But again, I would not waste my energy on that part. It's never happened like the projections have said, but we can see the facts as they are today. And we could see that the lower left-hand corner, real GDP growth in 2021 has picked up. It's assumed to be a little bit higher than the expected 2%. I recall hearing just 5 years ago was expected for the next decade. Pretty rosy numbers for 22 and 23. And then here you go back to the reversion to the mean 2024 on up to 2031 of 1.1 to 1.6. And US Treasury, 10-year treasuries below historical averages. So that's pretty rosy as well. And then headline inflation. But you can see that 2021, where we're at now with 10-year treasuries of 1.4, and then headline inflation 2.7, unemployment rates around 6, but the real inflation to you is much higher than 2.7% that you've experienced. And then we can go to the next. Investment returns. I wanted to show you this chart this morning because I think it's important to see where we're at with the stock market run-up we've had in the last 12 months. And see how that looks contrasted over a longer range of time, and contrast that relative to earnings. And in my view, that's very important. So you can see the upper left-hand side, 10-year annualized returns, and major asset classes from small to middle-sized to large cap stocks in America on the left-hand side of the first box on the upper left corner. And then you go across the top, value, blend, and growth stocks. And you can see, let me give you a reference point, reminder for many of you, value stocks are considered your stocks are undervalued. Sometimes there's very good reasons for that. Right now, some of those are in the banking sector. General Mills, Procter & Gamble are value stocks right now. So is PACCAR. But we often notice the growth stocks, and those are referenced by many as the FANGs, the Facebook, Apple, Netflix, Google, Amazon, Nike, Microsoft. So that's your growth. And you can see over 10 years on the upper right quadrant of the first left box, that is 17.9% over a 10-year period annualized. And that has happened in history before, decades like that before, but then the next decade doesn't look anything like that. So when you look at value, you can see almost 11.5%. It's right about at its long-term average, and growth is exceeding its long-term average historical returns. Roughly 100 years of data supports that. Then you can see the small stocks at the bottom of that upper left-hand box, 10.8 versus 13.5. So whether a company is small, middle-sized, or large in the growth sector, it has grown above market long-term averages, what they've supported, and yet the value is more in line with the long-term normal. Year to date is another interesting point I wanted to make, that you can see growth is petering, is slowing, but we're still only 6 months roughly into the year at 13%. That's pretty substantial. Value is rocketed up. And we had noticed that a couple of years ago that value stocks were very undervalued. And so many of you, we've been doing a more aggressive rotation into the value and captured a lot of that growth in the last 12 months. But we did it based on just straight fundamentals. What we saw is underpriced, yet companies with great long-term potential. Plus, value stocks often pay dividends. That's a small extra added bonus. Value stocks in the small area, 26.7%. Some of you have probably already noticed that. Huge run-ups in that space. That's just year to date. And since market peak in the lower left, this is one I hesitated to leave in or out, and I thought, it's interesting. So this shows, if we go back to February of 2020 at the market, when the market was at its peak, unemployment was running right around 4%. We had just best fundamentals of history in the last 50 years, probably. And you can see value, blend, and growth, looking very strong, and run-ups equally in both. And then since market lows, go to the right of that, and you can see 92% to 109 to the bottom numbers, 138 to 126. So a lot of value investments in the small area since the market bottom roughly last spring have skyrocketed. But the other part to this is also really important. In the current PE on the right-hand side, this is the price to earnings ratio. And this is a very simple ratio. Basically, the higher you go up on the number, the more overpriced the stock is. So sometimes an overpriced stock is not necessarily an evil thing. Their earnings are growing really fast. For example, like Amazon had a big return the other day, and their earnings are picking up. So is Microsoft. There's a reason that a lot of these companies are at very high priced earnings multiples right now, and it's a simple ratio, taking the basically aggregate or all the value of all the stocks outstanding and dividing it by the earnings, and then that's the price to earnings ratio or multiple. So we can see the large value through growth on the upper right. This is looking at the 20-year average on the bottom side of the slanted bar. And you can see in value, the price to earnings multiple is 13.7 versus right now 17. So it's well high of its 20-year average. And the 100-year averages are very, very similar to these 20-year averages. So growth, you can look at that and see that that's 30.5 PE versus 18.5 PE multiple over the 20-year average. And so it gives you a sense of the valuations right now of stocks in the United States are very high. And there's only one way to overcome those high multiples, and that is to increase earnings. Earnings have to be able to continue to change that denominator. That denominator has got to change, so that the only way to do that is to increase earnings, or the stock must come down. So this is what has me and all of us here on full attention to making sure that we're not paying too much for earnings through whether it's the indexes we're buying, the mutual funds, or the individual stocks. So current PE is 20-year average. You can see the same information right below that shows that information in a simple, a real simple way that you can see the percentages. So growth 165% over its 20-year average. And again, the 20-year average fits in nicely with roughly the 100-year average. So those are good numbers that take out some distortions. Anyway, you see that and see why we're making larger and larger tilts in all of your portfolios to the international, where there's not such huge run-ups like this. I hope that helps. Let me go to the next one. Global equity markets. This I want to go over very briefly. There's a lot of information in this one too. Some of it's not as important, I don't think, to you. The U.S. market on the upper left, S&P 500, that's the measurement and that we could use. And it shows year to date about 15.3%. And 2020, it was 18.4. 15-year average returns about 10% or 9.9. Beta is a measurement of risk. I'm guessing a lot of you aren't familiar with that term. We don't bring it up a lot, but we do use it here. So beta is a measurement of risks. For example, if we look at the S&P 500, it has a beta of 100. If you have a beta of anything less than that, then it's a percentage. So example 0.89 is almost 90% of the risk of the S&P 500. So this is saying that the S&P 500, the last 15 years, has had less volatility than what it historically has. And if you see all AC World X US, this is all stocks, all cap world stocks that are outside of the United States. The returns have been 9.4 denominated in US dollars and this year, and then 11.1 last year, and a beta of 8% more risk than the S&P 500. Again, over 15 years, its risk profile measured by its volatility, variability of returns have been 8% above the risk of the S&P 500. All these numbers show you 1.04, 1.18, 1.19 emerging markets. That makes a lot of sense. Emerging markets are in China, Indonesia, countries that are growing and expanding into a more maturing economy, but they're like America in 1905. And so it stands to reason they would have more risk. They have less quality of accounting measures to confirm that the earnings reports are accurate and honest and so on. They don't have all those tools that we have now. But you can see these below in selected countries even and so on. You can see Japan 0.73 beta, but you can see the returns 15-year annualized under Japan. That one stuck out to me at 3.7, so on. And Russia, look at that, 50% more risk than the S&P 500 and roughly a quarter of the returns. Okay. Next slide. Here we go. This is, I think the bottom slide is more interesting, but let's cover the top one real quick. This is equities versus equity and fixed income. So if you add a portfolio, if you add bonds or fixed income to a portfolio, this chart I wanted to show you so that you can see some data here that supports diversification. You can see the drop, the plunge below. This is a $100,000 investment, and it was made in February 19th at the market peak, and the market dropped, and within a month, the loss of capital would have been $30,000 if you cashed in. So your $100,000 eroded down to $70,000, and then within a year and a half, you wrote it back up to a net gain of roughly $30,000. This is the story that all of you have seen through your portfolios with the stock holdings, if not even more than this. And it also is educational, I think, in showing us a stock to bond ratio of either 40-60 or 60-40, whichever way you want to dice this up. So 40% stocks and 60% bonds is the dark blue line, still very reasonable returns. And the 60-40 stock to bond ratio, which is probably the most, we don't actually build portfolios as much with these ratios as we use other measurements, and we end up by backing in oftentimes to something like this. So anyway, to make a long story short, this is the answer for diversification. This shows the value of having a diversified portfolio still has provided very reasonable returns. We've taken this much beyond all of that. We've added a certain amount based on science of foreign investments, both stock and bond. And all of you have seen higher return. The vast majority of you have seen higher returns than that, even based on the 40-60, 60-40 split. But it's the point here is to show you how diversification has not plunged nearly as much, and it still ended up with very respectable returns. And then the bottom part here shows you the historical 20-year average of some major asset classes that all of you are in. So we have emerging market equity right next to real estate investment trust, smaller companies, 8.7 or almost 9%. High yield, this would be your corporate bonds from companies that have a little bit shaky credit, S&P 500, and then your 60-40 or 40-60 stock portfolio split. Domestic market equity, 5% in bonds and homes, and then the average investor, 2.9%. So this is the problem of getting in and out of the markets at just sometimes exactly the wrong at times. And then inflation, you know, this is where we've seen the big spike. 2.1 is very dubious right now. Then we could go into the next slide. So this is a piece that we keep in our conference rooms from time to time at the right opportune moment to show some of you that intra-year declines are very normal. They're very much more common than most people realize. And I think this is our last slide. So I'll open it up to questions. Is that the way you'd like to do that, Stuart, or do you want to wait till okay, so I'll handle your questions for this. But let me give you a perspective on this chart. I think there's a lot of value in this in years where there's especially big drops. This shows that the positive calendar year returns over a course of 20 years. You can see by the light blue and the dark blue are the years where that whole calendar year was down. But inside of the light blue, notice that there was some steep drops in those intra-year periods, you might call those. So on the way to the average returns, we have some pretty terrifying moments, perhaps. And that's the reason why we like diversification so much. That's the reason I've embraced it for so long, way before it was in vogue, and believe that there's a lot of successes in having a well-balanced, diversified for your goals, not anyone else's, not your coworkers, but yours. And then I don't follow trends like when you're 80 years of age, you need to have 80% in bonds or fixed income, or most of you know I'm not a huge fan of annuities, some kind of fixed income source. We don't follow that. We follow what your goals and your mission for the limited time you have here on Earth are. So with that, why don't we see if there's any questions that have been typed in? I haven't heard the phone going off. I forgot to say we should just do this electronically. Well, I see a few of them there. James, I'm glad your wrist surgery has worked out for you. Usually after you raise your kids, you downsize your home, but Thor upsized. Well, there's some truth to that. This is what happens when when I stepped out and let my wife decide what kind of house we were going to build, and I didn't want anything to do with it. And it turned out a little bigger, but you know, we got a fun playroom out of it. And it's having a bigger home is absolutely delightful, I found. Good question though, James. Bruce, I have 2 emergency accounts, savings and CD. The account is to cover my basic needs for 1 year. What is your recommendation what to do with this money to beat or match inflation? That is a question a lot of you are asking my team here. And we have been, we've always known, because we're always researching these things, safe money places. Notice I didn't use the word guaranteed. I used the word safe. And we're going to find those in very short-term treasuries. And there are a few ETFs, mutual funds we've been using for over a decade, almost 2 now, some of the ETFs, and exchange traded funds, that stands for, which is like an index. And some of those, an index meaning that they just buy a certain type of investment and there's no active management. The advantages are the fees are very, very low for us in those We pay almost hardly anything for executing that trade in your accounts. The other, we pay nothing actually. The other thing is that the active managed exchange traded funds are more of a newer thing the last few years, and they buy high quality the same way the index does, except that they actively manage it based on the state of affairs of each day and hour. And so we've been using more and more of that for the cash equivalents, and also just really getting back to the basics of looking at what are you trying to do. We've had a lot of clients that haven't been able to travel. They haven't been spending as much in the last 12 or 18 months. And so many of you are winding up with a great deal of cash in your accounts. And we're simply just buying lower priced individual stocks for the tax benefits we get from that, because we don't have to sell them off for capital gains if we don't want to. And we can do some limited harvesting on that. So tax loss harvesting. So, you know, cash equivalents, we're getting very low yields on those inside of these safe bonds. But we have been able to see the last few years higher than we thought we would get. That's 2 to 3%. And just looking at the overall situation is really the right way to handle that. I know that I wish I could be more clear, but that's how I can answer that. What is your outlook on international or emerging markets? So the emerging markets haven't had as substantial a run-ups as our domestic markets, nor have they had the sharp run-ups that recently the more international markets such as France, Germany, UK, Australia, Scandinavian countries have had. So the emerging markets are still very appealing. And so for roughly 20 years, I've been putting people's retirement assets about 4% allocation to emerging markets for two reasons. They don't move with our markets the same way all the time. And there's been many opportunities to buy low into those areas. And this is another one where it has not had a significant run-up. And emerging markets are more fairly priced than US markets right now. When you look at price to book, earnings, price to earnings ratios, many different fundamental metrics, international stocks are not as priced as highly as US stocks are. And so that's another reason we've been moving away from our international allocation of 15% to 20 and even 22 and 25% for some of you. And plus emerging is on top of that of roughly 5% for the majority of portfolios. I see my 401k bond funds are down, which I'm not used to. Would you suggest moving a little over to international? Well, bonds are year to date, many bonds are down. About 2/3 of the bonds that we have our clients into are up, roughly speaking. And that's because I moved away from a more passive approach of bonds to a more active approach of bonds. And so the passive approach to bonds is just simply buying a bond index. And when you have these really low rates, what happens when interest rates go up just a little bit is the prices drop on the price of the bond. So that's kind of a simple way of saying it, but it's accurate. And so we've moved away to the more active, and that has helped a lot in the bond area. And that's the reason why almost all of you are up year to date. While a 401k that has a bond fund in it, if it's passive, it's probably, we need to look at that and look at, Brian, some kind of active bond fund you have available to you in that. I'd be glad to help you with that. And then Wendell, I was surprised to see the strong performance of REITs over the last 20 years. How have they fared since February of 2020? Basically, since 2020, REITs are up 12 or 14%. So I'm thinking an 18-month time frame here is what your question is covering. So about 14%. We have had a REIT that we have many of you in called United Mobile Homes. And you may be questioning what I just said, some of you, because that one has gone up about 100%. And that's something about 20 years ago I started using as a small sliver of your real estate investment trust allocation, you might say. And UMH had a substantial run up. It's a company that's been around since '68. And I've been, it's been well researched, and it just had a much more substantial run up than I would have ever expected in such a short period. That's why majority of our client REIT section is up far more than the average. Dan and Terry, use my crystal ball. I broke it. It's broken now. So now all I have are the fundamentals to go by. And do you foresee a significant US market correction coming in the near future? Actually, it wouldn't surprise me at all with these high valuations. What would I do about it? Nothing. I would do nothing about it, because I've been wrong many times. When I've seen these high valuations, they go on sometimes longer than you might expect. They do make me uncomfortable. I'm not, gonna shade the truth here in any way with any of you. It does make me uncomfortable, the high valuations. You saw the valuations I just given you. Yes, they are historically very high, and they can go higher, and they have in the past when they've been this high. So it's just, we're very cautious right now. Does that mean get out? That could be a really bad mistake, because if they run up and you miss that, it could be a recovery you could never recover from. So diversification, that each of you, we have carefully gone through and examined your income needs and making sure that you have safe investments to allow us to make sure your income doesn't change, so that we can have enough safe investments in fixed income sources. And that's the reason why your bonds, none of you, your bonds are down in aggregate year to date. And yet the aggregate bond index is down. But I have not seen a single client account out of 840 of you that has a total bond portfolio that's down. You are all up. So that's because of the diversification. We bought a lot of different kind of bonds, and we switched to more actively managed. Deborah, what do you feel about taking monthly fixed pension versus a lump sum? There is no inflationary attached. Huge, awesome point too, because the pensions aren't going up with inflation unless they're a government pension, like the TERS, the Teachers Employee Retirement System Plan 1, 2, or 3, or not 1, but 2 and 3. The SERS, the FERS, the PERS. Did I leave any out? Is there any more than that? I think that's pretty much. What's that, Dalton? Oh, you cannot leave out the left 2 and 3. That's the law enforcement officers and firefighters. Okay, so there's plans 2 and 3 there as well, and those have inflation adjusters not to exceed 3%. So see, the states were clever enough when they rewrote these years ago. If inflation takes off and gets out of control, you're capped at 3% increase. However, it's still far better than all of the Boeing and so on, that their pensions, they can't afford to have inflation adjusters in those if inflation takes off. So there is no inflation adjustment. And that's what Deborah's asking. And the answer to that is lump sum is when you can, instead of taking that annuity income or that pension income at retirement, you can roll a lump sum into an IRA account. And for some of you, that has proven advantageous. For others, it's better to take the income. It really does depend on your financial circumstances. And as fiduciaries, I sleep well at night knowing that each one of you has a financial strategy that's been created here. I know it takes a little bit of work. It definitely does on our part. However, it allows all of us to sleep at night feeling very reassured that we've spent some quality time going through what is the best thing to do. Because for some of you listening right now, you have heard us say you're better off taking the pension income. And for some of you listening, you have had us show you why it's better to take the lump sum. So it's almost like 50-50 roughly. would be in addition to my 401k assets. Okay, I think we've answered Deborah's questions. Any more? No more questions? All right, so Stuart.
Good morning, everybody. Well, you're perhaps aware that Washington State has created a new long-term care payroll tax. It's going to affect W-2 employees, and it's going to begin January 1 of 2022. I printed some stuff off here that I'll reference. I'm guessing it may be of concern to those of you that this might affect. It will be a 0.58% employee income tax, and it will affect everybody who's a W-2. So this thing is in some degree of flux, and it obviously has been designed by the state to mitigate their Medicaid responsibility by having everybody who is a W-2 pay into it to help subsidize the state's 50% responsibility to pay for those folks who have to go on state welfare. So you could argue that this is it's not an unreasonable step because so many people are living longer, they don't have long-term care insurance, and the average household is essentially wiped out within 1 to 2 years, at which time they go on the state rolls and the state has to pay. So in that sense, it's an understandable, from the legislator's perspective, it's an understandable attempted remedy or mitigation, at least for the state responsibility for it. The way they're doing it is, there's no, I guess, satisfactory way of approaching doing this, and it seems somewhat arbitrary and unfair. But the bottom line is, if you're making a gross of $100,000 a year, you will, and you don't have long-term care insurance, and you have to have it by November 1 of this year, you are going to, as long as you reside in the state, you're going to have to pay it for the rest of your working life. Once you stop, then you'll still be on the rolls and you'll be able to take advantage of the program the state is offering, which, if any of you are familiar with long-term care coverage and the expense of long-term care, it's not a lot. So what is it? And this is at this point not subject to increase. If after 3 years, by the way, this program will not go into effect until January 1, 2025, even though those of you on W-2 will begin paying it January of 2022. So what will happen is, if anybody needs long-term care insurance who's on this state program after January 1, 2025, if you have a legitimate claim, they will pay a maximum of $100 a day for 1 year. Ergo, that's $36,500 for long-term care. I don't know, everybody has different levels of understanding about what triggers long-term care and what it is, but it's not health insurance, it's not life insurance. It's predicated on your need for help with what are generally referred to as activities of daily living. You have, like my mom, when she turned 85, she had a series of mini strokes. Everything changed overnight. She had a long-term care policy, and it was triggered because she needed help with things most of us take for granted: getting out of bed, helping bathing. Those are the two main things she needed. Getting out of bed is transferring out of chair, out of bed. So she ended up using it at that time, about $170,000 of a $200,000 policy, because she opted to move into a very nice assisted living facility where she could have help with those things. So that's why people get long-term care insurance historically, is to pay for those things, so they, so their life savings aren't eroded. But and therefore the state program is designed to be very minimal, but let's understand the reason why they're doing it. In the aggregate, if they start collecting this tax, this payroll tax from everyone, then ostensibly they're going to be able to have a lot more money flow into the state coffers to help pay for the Medicaid program. And most of us who have sufficient assets won't ever be needing to access that, and therefore that money can be allocated toward those folks who do. So it's a, it's a reallocation of money. We've seen that. Medicare is the same thing. People who make more money pay at a certain level, go on Medicare, they pay more than the basic amount of $148.50 a month for Part B. You can pay up to $500 a month depending on your income. So, a lot of people are, understandably unhappy about this, but I'm not defending the state doing this, but that's the reason why they're doing it. Whether the money that they collect will actually be in place to use, who knows? But there are significant limitations of this plan, which is why a lot of people are considering buying their own long-term care policy, which I stress needs to be in place prior to November 1. And but there's a problem with all of this, because the carriers that have historically offered long-term care coverage within the state, guess what they've done? They've pulled out. They don't want to deal with it because what started happening is that, in particular, a lot of younger people would buy very small policies. Didn't cost them that much. Policies, their own policies that would be sufficient to take them off the payroll tax rolls. And they don't want to deal with policies that may only have a premium of $400 or $500 a year. So they've pulled out, with the exception of one company at this point. This is just for straight long-term care insurance. It's called NGL. And what NGL has done, first of all, they have limited those who can get a long-term policy through them to a minimum age of 40 and a maximum age of 79. That's not atypical historically. So that's the only game in town for straight long-term care insurance. However, what I've been seeing from folks who've been contacting me who have an interest in both, one thing that's happened inadvertently, I suppose, from all this is that it's heightened the awareness of the issue of the need and expense for long-term care. So I've had a number of people calling me saying, I know I've needed this, I put it off, and therefore they're not just looking at it from the perspective of mitigating or eliminating the payroll tax responsibility. And they are looking at, significant policies, ways to get it, and therefore mitigate or to eliminate the payroll tax. But what is available, and what I've been kind of focusing on with clients, are what are called hybrid plans. And by that I mean there are a number of companies who are still offering either UL, not term life, but usually universal life type policies with a long-term care rider. And it's any rider you're going to get on any of these policies is going to be provide sufficient coverage that the state will recognize it as a long-term care policy, and therefore you wouldn't be subject to the payroll tax. So they're not inexpensive. If you're a 60-year-old in good health and you're looking for a real long-term care policy with inflation protection that's going to be there in place for you when you need it, you'd probably be looking at somewhere in the neighborhood of $5,000 a year for a plan. It varies depending on how much you feel you can handle yourself. But the good thing about this is that whereas if you have a traditional long-term care policy, it's, for lack of a better term, it's use it or lose it. Nobody wants to use their policy. You know, we all want to have a happy life and go out when we're 92 in our sleep with a smile on our face. And at that age, it's about a 10% chance that's going to happen. So, but the point is, in that sense, it's use it or lose it. Whereas with this hybrid policy, obviously, because it's a life policy with a long-term care rider, if you never use it, and at which point you pass away, then that the $100,000 or $200,000 benefit, whatever it is that you buy, is going to transition to your heirs, and that is appealing to a lot of people. So this, for some people, I think they're, you know, the heightened awareness of the need for long-term care has, you know, this whole deal through the state has been useful. The way they're approaching this, to me, it seems kind of arbitrary. I mean, if you're self-employed, you know, if you're a partnership, whatever it is, well, partnerships, I shouldn't use that as an example. You're still going to be W-2 and have to pay for this. But if you're self-employed, you don't have to get this. The way the state promotes it is they're saying if you're self-employed or otherwise not required to pay this payroll tax, you will be allowed to opt into it. Now, why would anybody opt into it? Because the one advantage, I guess you'd say, about getting this type of, or this state policy, this state coverage, is that your health isn't a factor in the determination of whether or not you can get it. So even though it's minimal coverage, $36,500, and it does not have a cost of living increase associated with it. So if you're 40 and you need it when you're 80, that $36,500 is going to be, what's that going to be, $10,000 or something, but it's still coverage. And so from that perspective, it's, you know, some people in a situation where they know they couldn't otherwise get it may opt to get it, even if they don't have to. So there, you know, there are other aspects, components to it. If you're, and I, you know, I should preface this by saying this is still in flux. All this thing was, I believe, formalized by the state in April of this year, and they're still crossing T's and dotting I's on it. But one of the oddities that I believe I'm clear about this is that, let's say, for example, you're 65 and you're contemplating retiring in the next 2 years and you're a W-2. So what happens? You continue to work for another 2 years, beginning January 1, 2022. Your employer, and this is the responsibility of the employer to facilitate this, the extraction of this money from your payroll and to pay it to the state. You are going to pay that 5.58% for those 2 years. Well, if you haven't completed a steady 3 years of payment, which you would stop once you retired, you're not W-2 anymore, you're just going to lose that money. Likewise, if you move out of the state, let's say you have you're 40 years old and you pay into this until you retire for 25 years, then you have the audacity to want to move to Arizona, sayonara, all that payroll tax. Why is that? Because you don't live in the state any longer, and this is a state deal. So, you know, there are going to be short-term and long-term challenges to a lot of this stuff. But the way it stands right now is that if you are W-2 beginning January 1, 2022, sayonara 0.58% of your gross income. These folks are shaking their head over disbelief. Well, so on that happy note, I'll be happy to answer any of your questions if I can. What's that? Are you able to see me? Oh, right here. Well, best is a word Brian, that I hesitate to use. As I already mentioned, let's see, Boeing is working with a supplier, I guess a long-term care company, best long-term care plan. Well, as I touched on before, Brian, everybody's needs are different. If they're offering an internal long-term care policy, then what they would be offering, I assume, are several cost levels and approaches to coverage. A traditional long-term care policy is one where you could, for example, buy a 3-year benefit, a pool of money at $200 a day. So what's that? 1,800. What's 3 years?
Did you say
1,095 days? So at $200, you'd be buying about a $200,000 pool of money. Okay. Well, then, and let's say that costs $4,000 a year for it. If you added an inflation protection, say 3%, that might take that up to over $5,000 because it's going to increase every year. Likewise, if you got a 5-year policy, that might add another $1,000 onto it. So when you say best is, to me, best determined by what you feel, first of all, you can afford in terms of premium, and then secondarily, in the event that you needed long-term care, how much could you handle? So if the monthly cost for your long-term care is $6,000, which is not atypical, could you afford 3 of it? Well, if you could, then, and this is something you would want to perhaps discuss with Thor or Troy, as to the extent to which you could pay to mitigate your overall expense. So that's the best way to answer it. Everybody's different, depends on where you're at financially.
What Stuart's talking about here is that there's a law that's been passed that's being challenged in the courtroom, and it's 0.58. So if it's 100,000, that's $580 a year of your income you're going to have taken from your paychecks. Now, those of you that have long-term care insurance policies in effect right now, you're exempt from this, and you do want to be exempted from this. This is not good for you.
No.
This is never going to be good for you. The reason why is Stuart's gone through a basic litany of why this is a garbage contract, and it is. So let's just not mince the words. It's garbage, and it is. And I don't think that's dishonorable of me to say what garbage is. And then the reason it's garbage is because it has limitations that no insurance company has ever been allowed in Washington State to contractually do to people.
Sure.
So if you think some of the private ones are trash, then pull out your examination glasses and look at this one. So my point is right now that all of you that we've done a financial plan for, which is with rare exception, all of our clients, we've already gone through the need for long-term care insurance. And so when the need existed, we suggested that either you go to your friend or somebody you know that sells it, perhaps. There's not very many experts in that area, actually. And if you don't have anyone, we've recommended Stuart. We're very comfortable with Stuart, and does a fantastic job and has been very honorable to people. The other thing I got to say about this is that when we go through your financial plan, we find that the majority of you have enough resources to cover that bucket of money that the long-term care policy is offering. So we find that you're better off, instead of paying the premium, to really self-insure. You're actually, the vast majority of you are better off. But there are some of you that it is best advice to consider buying your own personal private long-term care insurance policy. And that's when, if you don't know someone, we get Stuart on the line for you. And we actually recommend the amount that you ought to be doing, but that's very few of you that comes to each year. Then the other point is that the state plan is very muddy right now. It was done very hastily, and it was really rammed right through. And so I think that's obvious to anyone that happened to see that happening. It was just stunning how the democratic process really, I don't think, worked in that situation. So what we have is a controversial piece of garbage contract in Washington State that has been foisted on the people, that is widely known by experts in the field right now as being challenged in many courtrooms right now. Oh, yeah. So it's very controversial, very heavy-handed, and very bad for you. So that's why I have been veiling everybody, the 10 or 11 coworkers I have here, with a group plan for us to be exempted out of it. And that's I think the main point of what. Then there's Medicare we wanted to make sure to address too, but it's hard to go through the details on the state plan right now. We're just warning you about it because we care about you, and it appears to be happening, but it is being challenged, and so it's hard to really get your finger on something that, you know, if it went through as it is, it would be amazingly dreadful. So we hope that the court system works and stops this, what's been foisted on you and me. So what we have is Medicare Part A and B, unless there's
no. Well, the only, and you just brought up an interesting point. What part of what Thor's getting at is, will this actually happen? Is some court, somebody, is the state going to throw this out, and therefore the payroll tax along with it? Well, hopefully that happens. But if it doesn't happen, the fly in the ointment of all this is that even though you may not, your income and assets may be such that it appears that you'll be able to self-fund your long-term care needs. Problem is, you're going to have to pay for the darn thing until you stop being a W-2. So that's the fly in the ointment. And so anyway, I noticed somebody had asked me on their something about can I recommend or discuss long-term care insurance. Let me just say that, if I may, it would be more appropriate to give me a call at my office perhaps next week. I don't know if you have my email address or if you can put it up there, but I'm sure you can get it from the office here or on here.
We could give it out right now.
Yeah, the
right
thing is, everybody's different, so your needs are different.
It's a good idea.
Your health is different, but and it's this sort of thing is best discussed, you know, on a one-to-one basis, one-on-one basis. Okay, I thought you were going to cover valuable information for those preparing to enroll in Medicare. Yes, David. Sounds like you're about to enter the world of Medicare. And there is some valuable information about preparing to enroll in it. Once again, I would recommend you give me a call or email me. But fundamentally, it's this. So I'm going to just transition off of that other thing. We've covered it kind of the best way we can, I think, the payroll tax. You know, there are on average about 6,000 people a month in the state of Washington going on Medicare, and that's reflected nationwide. You know, there's the baby boomers are entering this world. Medicare, yeah, I'm telling you, it's a very good coverage. There are a lot of options, and there are there's a process that everyone going on to Medicare has to follow. So I think the best way to answer David's question is to understand, again, to give me a call, but to understand that, well, there's two underlying issues associated with entering the world of Medicare. If you are a person who's already, or by the time you begin going on Medicare, if you're already collecting Social Security, you will receive automatically in the mail about 3.5 months prior to the first day of your birth month, your Medicare card. It's all done for you. Medicare A hospital and Medicare B medical will be on it, and they will tell you, unless we hear otherwise from you, the first day of your birth month, you will be going on Medicare, and because you're collecting Social Security, you will be dinged out of your Social Security a minimum of $148.50 a month for Part B. And as I mentioned before, if your income is goes higher, then significantly higher, then you're going to pay more for that. But you must have Medicare A and B in order to get the supplemental coverage. So I guess you could say it's your ticket to ride. So when I hear from folks who are, you know, that most folks that I talk to are have been made aware one way or another that they need to start addressing this, you know, at least 3 months before the first day of your birth month. Let me say one other thing about this birth month issue. If your birth date happens to be the first day of a given month, let's say it's let's say it's September 1st, your effective date for Medicare is going to be August 1st. I don't know why, but that's the deal. Any other day of the month in September, it will be September 1. Well, if you're entering the world of Medicare by September 1, and you're not collecting Social Security, you need to apply for Medicare A and B yourself. And I help people all the time with this. You go to medicare.gov, and it can be a little tricky getting to the right place to see where you apply for this. But again, it's not going to be done automatically because Social Security isn't aware of you. And you do need to get A and B. The whole objective here is, let's say you're turning 65 and you're no longer going to be on group coverage, or you're self-employed and you can't wait to get out of the state plan, which is understandable. You need to start addressing this ASAP, because the whole point is, number one, it takes about 30 days for the feds, the state/feds, to process your card and get it out to you. And you need to have that card because it has your newly minted Medicare ID number on it, because you just entered, or you will be entering this world. So the point being is that you have to have A and B before I or an agent that you may be working with can help you with the C and D part, which is the supplemental and the drug coverage. So I encourage people when they call me to get going on it, because the whole objective here, and that can, by the way, can take a while. I take as much information as I'm allowed to get that may be pertinent to your particular needs for coverage, because there's very different approaches to coverage. And then and just so you know, I don't work for any company. I'm appointed with all of them. I don't have any axe to grind. I'm paid the same amount. You don't pay me anything. I'm paid the same amount regardless of what company you work with. Understand, if you're within a 3 or 4 month period of turning 65, you are a celebrity. You will be getting information from every carrier, Premier, Regents, United Healthcare. They're all going to be sending you stuff because they want your autograph. And the reason they want your autograph is because Medicare is going to be paying whichever company you pick, depending on where you live, somewhere around $750 a month to insure you. And that's because you paid into Social Security. It's part of your entitlement when you turn 65, if you so choose to use it. So the point is, everybody's needs are different. There are wonderful plans in the world of Medicare that cost nothing. If you had a lot of health stuff going on, or if there was some other reason, and by the way, those are called Medicare Advantage plans. If you have, if there are specific circumstances where it's in your best interest to do so, there's a different road you go down, which is to get a Medigap plan, sometimes referred to as a Medicare supplement. And people who get those with a drug plan, they're going to be paying somewhere around $200 a month on top of that Part B, but it's the best thing you ever had. Well, essentially, if you get Plan G, which is typical now, once you've paid, I think it's $205 now, $205 annual deductible for any medical expense, everything is covered. So I have about 15%, I maintain about 800 clients. About 15% of them have Medigap plans, and the majority of them have it because it is clearly in their economic interest to pay the premium rather than what they anticipate to be their medical bills for the following year. So that's the deal, Brian. I'll be happy to chat with you if you want. And I gather some health information because it helps me to help you, your medications, who your doctors might be. And then, I go through that process. And typically what I'll do with a client is, in the age of COVID here, we're somewhat transitioning out of it, but I'm still, it seems to work pretty well just to send those plans and those approaches to coverage, via email. And then we spend some time, if you want to do a FaceTime or Zoom or just regular phone call, we spend some time and go over them. And I try and make sure everyone understands how this works. I'm telling you, generally speaking, with the exception of Boeing employees who have the best coverage in the world, if you're anybody else, you'll be, I think, pleasantly surprised by what you can get by going on to Medicare. So it is time for me to enroll in Medicare. Hooray! However, I am still working and am covered under my employer healthcare plan. Is it correct that I should sign up for Part A Medicare only until I retire? Yes, you got it exactly. You can go on to medicare.gov. And again, if you want to call me to get you to the place, or if you go on there, there's the page, second or third page, you're going to want to scroll down about halfway through the page, and it will say apply for Medicare here or something like that. It's a little blue box. That's where you want to go. And of course, once you get in there, you want to make it clear, which you'll be able to see how to do it, that you want to apply for just A. You don't want to get Part B. Sometimes people think getting Part B makes sense because it acts like a supplement to your group coverage. That's not what happens. I have people calling me all the time who've got Part B for a couple of years because they think it picks up everything. It doesn't. They're essentially paying out the same amount. What?
No, I was thinking somebody shut the door there. So
I keep forgetting I'm looking at the wall here instead of you folks. But they think that they'll just pay Medicare Part B limit amounts, which is typically not much different than what your group plan would pay. So you would still have copays. There's no reason, if you're going to stay on your group plan, to get Part B.
Tony's got a question. He wants to know how he's to notify his employer so that he's not getting money sucked out of his paycheck. So there's a letter
yeah, exactly. There's I had highlighted this. How do you apply to opt out of the new LTC payroll tax, Tony? Between October 1 and December 31st of 2022, which there's an obscure reason for this, but you would want to do this right away. Beginning October 1 of this year, you will need to complete and file a waiver application with the state attesting that you have other long-term care insurance. Once you opt out, you cannot opt back into the program. Tragic. The opt-out is permanent. You must provide a copy of the waiver certificate to your current and all future employers. Now, I couldn't find any information about how to get this application, the waiver application. Do you have any knowledge of that? I just couldn't find anything about it.
No.
But if that's something you need, your employer who has been made aware of this may have that form, or your HR person may. And if I find out, I'll contact Thor, and you can disseminate it that way if there's a way to do that.
We'll be learning more about this. Right now, it seems to be a big cluster. I think that's it. I think we've answered.
Were there any other Medicare questions?
Cynthia's got hers answered. Tony got his answered.
Yeah.
And Kelly, what if I take the employer plan, but then change employers?
Is this oh, hi, Kelly. Is this regarding the state, the other thing? Yeah, I had some information about
Does this
that.
apply to residents of Washington and not those employed in Washington residing in another state? I'm not clear.
There's information about that too that I was reading about Oregon, and because remember, it's the employer that has to
deduct this from your
yeah,
paycheck.
they've got to do the work. And there was something I found about that. They use Oregon as an example. I'm not sure if you want me to take the time to find out now, but you could also Google in and say, what if I work for a company that's out of the state? Was that the question?
Partly. Does this only apply? So what if I take the employer plan, but then change employers?
Yeah,
so
that
that stays with you.
Right.
But then when you do the math on this, Kelly, and you look at 0.58 for a lot of paychecks, you're basically not getting any bang for your buck for what you're paying into it over time. But there's the real problem is the way that the language in the contract, there's not even a contract, the way that it's written and so on. It's not real, quality. And then the tax is not going to stay at 0.58.
No, that's true.
Never happens.
I mean, if this is like the lottery a few years ago, I shouldn't necessarily use this as an example, but you may recall when Gregoire was in, they set up the fabulous lottery program. What was that designed to do? It was designed to fund education. How long did that stay in the education? Not very long.
That's
and so, I mean, you see this all the time.
It's in every AMP
it's a skim
market
off
now,
and more money for the state,
especially for the people that don't know math. It's like a tax on them. Okay, any other questions? I think we're done. So we will stay tuned. We'll send you out newsletters for the next time there's something that we think is really relevant that needs to be brought to your attention. And Tony has another question that's popped up. One reason not to sign up for Part A at 65 is the person's contributing to an HSA account. You can't do that if you're on Medicare.
Yeah, but that's I'll get a clearer answer to that, Tony. But by signing up for Part A, to be fully on Medicare, that's A and B. That means you've gone on to Medicare. And I honestly don't know. I know I've read it, but I can't remember if what you're saying is correct. I don't think that it is, though, but I will look into that.
Thanks, Stuart.
I can't remember.
That would apply to a few people. Good question, Tony. I got a gut feeling I've seen that answer too. And I think it's if you're on Medicare but not B, you can still contribute to the HSA, but it needs to be confirmed, I think, or are you sure that that's...
No, I'm not sure. I'll confirm it.
So we've gone through a lot of information. I had to go through it pretty briskly because there's so much. It's hard to know what to keep in and what to keep out, and I keep having to delete things because I have such so many ideas I want to share with you. So let us know when you have any ideas you think ought to be brought up in our next little webinar forum, and I look forward to seeing each of you in the office. We're doing few and fewer Zoom meetings, but still, I think we're about roughly 50% of you, even a little bit higher. We're doing Zoom meetings for the last 18 months, and that's been trickling more into the higher percentage coming in now. So I hope you've received some value from this, and I sent off a couple PowerPoint slides to a couple of you that already emailed me, and one of them keeps bouncing back from one of you. I don't know what's wrong with that email address, but I just replied and it didn't go through. We'll leave it at, do we have another question?
Yeah, Kathy does. Medicare question. Is it true that Medicare brokers will not be getting reimbursed enough from Medicare to handle clients who only need help with Part D decisions? Well, wait a minute. Okay. I know what you're asking. And I do this a lot, Kathy. On the Medicare.gov website, a person in your situation who has a Medicare supplement as you already know, you have to buy a separate drug plan, whereas with the Med Advantage plan, it all comes together. But in your situation, where you need to buy a separate drug plan, yeah, the agent doesn't get paid very much because there's not much money involved. You can get a very good plan for about $6.50 a month, but that's not the point. If I do this all the time, I never have an issue with it. If you want to call me, if I can be of help, or you can do this yourself, you can go online and get to if it's at some point you'll see if you're just applying for Part D. Okay, then you go to a page where you list your medications. Once you're done with that, up pops the plans in order of how Medicare has aligned them with your drug needs, and it will say Silver Script RX 654 number 1. Well, that means it's in all likelihood going to be the most cost-effective plan for you. And right there, you can get the number of the carrier, and they have an in-house agent who will help you get on the plan. But I stress, if you are unsure about it or want to ask questions, I don't mind helping you at all. I'm not going to end up signing you up. There's tons of companies that offer drug coverage, and I'm not even appointed with them. I don't want to be. I'd much rather just help you
make the right decision.
Yeah. So I'm happy to do that.
Yeah, we're in the problem-solving business, and anyway, so if you have any more questions, email us, and we'll be glad to help you out. And Stuart, I appreciate your help.
My pleasure.
Through the years. And also, I want to say thank you to the staff here, the people that helped me make this thing operate to help each one of you. And so with that, I'll let you enjoy your day, and give us any suggestions for the next time. Take care. Bye.
Bye.